40 test questions to help you pass your real estate exam on the first try. My name's Darren Tsai. I'm a licensed real estate agent and loan officer in California. I'm making this video to help you pass your real estate exam on the first try. So this video is going to be a compilation of a 10 question video, another 10 question video, and 20 more questions for a total of 40 questions that you'll probably see on your real estate exam. Okay, let's start with the first 10. Question number 1. Which loan is often used by older homeowners who have owned their homes long enough to gain a great deal of equity? A. Variable or adjustable rate mortgage. B. Shared appreciation mortgage. C. Rollover mortgage. D. Reverse annuity mortgage. The correct answer here is going to be D. Reverse annuity mortgage. So a reverse annuity mortgage is when the lender actually pays the borrower. The loan is not repaid until the borrower dies or sells the home. A more common name for this loan product is just called a reverse mortgage. I'm sure many of you have already heard of these. To make sure you get this question right, it's really important that you know what each type of those loans is. Question number 2. The taking of another person's rights and obligation in a pre-existing contract is known as A. Novation. B. Ostensible liability. C. Assignment. D. Assumption. Correct answer here, it's D. Assumption. So once again, to get this question right, you're going to need to know the definitions of each of these words. That will make it super easy for you to get this answer correct. And let's walk through the explanation here. Assumption simply involves taking or receiving another person's rights. Assignment refers to giving the rights under a contract to someone else. And novation actually releases the withdrawing party from liability under a contract. If you know the definition of all 4 of these terms, this is an easy question for you. Question number 3. Who are the parties to a mortgage? A. Mortgager, mortgagee. B. Lender, lendee. C. Trustor, trustee. D. Vendor, vendee. We're not talking about a vendee Starbucks here, okay? The correct answer here is A. Mortgager and mortgagee. So the parties to a mortgage are the mortgager, who's the borrower, and the mortgagee, the lender. Question number 4. When a trust deed debtor is in default on a loan, the loan may be reinstated if all delinquencies and fees are paid prior to how many days before a trustee sale? A. 5 days. B. 3 days. C. 7 days. D. 10 days. Correct answer here is A. 5 days. So basically, a borrower has until 5 days before a trustee sale to pay all the delinquent amounts and fees. Question number 5. What type of note calls for interest payments during the term of the loan and principal due at the end of the loan? A. Balloon wraparound loan. B. Amortized loan. C. Installment loan. D. Straight term loan. The correct answer here is D. It's a straight term loan. In a straight term loan, only interest is paid each month, and a lump sum principal payment is due at the very end. Most 30-year fixed mortgages that we are familiar with are amortized loans. So that means every month, the borrower is paying both principal and interest. Okay, so now that we've gone through 5 financing questions that are going to help you pass the exam, if you want a test bank of your own questions and to really prepare for the exam, I'm going to drop a link in my description. So full disclosure, it is an affiliate link. I do get paid a little bit if a purchase happens. However, Calibri is the platform that I use to pass my real estate exam and loan officer license exam on the first try. I'm currently using their platform to get my broker's license as well. So it's a platform that I actually used, and I stand by their product. Back to the questions. Question number 6. A GI loan is the same as A, a co-insured loan. B, a conventional loan. C, a FHA loan. D, a VA loan. The correct answer here is D, a VA loan. So a GI loan is often referred to as a soldier's loan, and it's guaranteed by the VA, which is the Veterans Administration. So GI loan, VA loan, essentially the same thing. Question number 7. The term debt refers to A, an instrument used in many states in place of a mortgage. B, the amount of money owing on a note or a promise to pay. C, the transfer of real property by a private owner to a public agency. D, the movement of money out of savings into a higher yield investment. And the correct answer here is B, debt refers to the amount of money owing on a note or a promise to pay. So with this question, once again, if you know the definitions of certain words, you're going to be able to answer this question pretty easily. Question number 8. The type of lender having the greatest percentage of assets invested in residential mortgages are A, mutual savings banks. B, savings and loan associations. C, life insurance companies. D, commercial banks. The answer here is B, savings and loan associations. So, savings and loan associations are the most invested in residential mortgages. They take deposits in savings accounts and they use those funds to make loans for depositors. If you think about your local credit union, right, that's like a savings association. Okay, question number 9. Mr. and Mrs. Buyer are approved for a $72,000 loan. Their monthly payments will be $9.35 per thousand for 30 years. How much interest will they pay over the life of the loan? A, $170,352. B, $601,200. Answer C, $242,352. Answer D, $673,200. Correct answer is A, $170,352. I'll just walk you through the math here, right? So your loan amount is $72,000. You divide that by $1,000, right? And you get 72. You take the 72 times the $9.35 per thousand for 30 years. You take that 72, multiply that by the $9.35, which gives you a $673.20 monthly payment. You take that monthly payment number and you multiply it by 360 months, which gives you the total payment of $242,352. And then you subtract the loan amount, and that will tell you the interest. That is a lot of interest. It is more than the actual loan balance. So if you notice, Mr. and Mrs. Buyer are actually paying more interest than the actual loan itself over that 30 years. And this is why and how banks and lenders make so much money over a long period of time. Question number 10. We're here at the end. Under the Uniform Commercial Code, also known as the UCC, all of the following are required to be on the face of a promissory note except, notice that except in there, A, paid to bearer or to order. B, payable on demand or at a definite time. C, the holder's signature. D, made by one person to another, both able to legally contract. Correct answer here is C, the holder's signature. So the UCC requires a note to be signed by the maker of the note, the borrower, but not the holder of the debt. Okay, now let's dive into the next 10 questions here. Question number 1. Typically, a developer / builder would have what type of mortgage on their development? A, an interest only with annual payments due. B, a conventional fully amortized. C, a wraparound with a partial release clause. Or D, a blanket. The correct answer is D, a blanket. And I'm sure many of us around the country could be using a blanket right now. I'm sure it's freezing. Drop a comment what state you're in and how cold it is. The explanation for this one is a blanket mortgage covers more than one property. And so with builders and developers, they buy a bunch of different parcels of land and they build on each one. But a blanket mortgage allows them to release parcels as they're sold. And so this type of mortgage is the best option for builders and developers. It's important with financing questions, you understand the different types of loans and financing options. Question number 2. The promissory note is A, evidence of the debt, B, a mortgage, C, a land contract, D, security for the debt. The answer here is evidence of the debt. So the promissory note serves as evidence of the debt, while the deed of trust is the security for the debt. Option number 3. Which disclosure is not required by Regulation Z of the Truth in Lending Act? A, the appraisal fee. B, the loan origination fee. C, the total monthly payment. And D, the amount of interest to be paid. So the correct answer is A, the appraisal fee. And the reason why is because appraisal fees are not actually considered bank charges, so they are not required under Regulation Z to be disclosed. When you are studying for the exams, I would definitely take some time to know what's going on in Regulation Z of the Truth in Lending Act. So with the financing questions, they do like to ask a lot about the Truth in Lending Act. Question number 4. Which federal statute requires a lender to give a borrower a statement of total interest being paid over the life of a loan? A, Equal Credit Opportunity Act. B, Regulation Z. C, Fair Credit Reporting Act. D, Federal Fair Housing Act. The correct answer here is Regulation Z. So we just went over this in question 3 as well. You want to know a good amount about Regulation Z and how it protects consumers. And a quick explanation of this one, right? Regulation Z of the Truth in Lending Act requires lenders to disclose the total cost of the loan, including interest over the lifetime. This makes perfect sense. They're trying to protect the borrowers. Borrowers do need to know the total amount they're going to be paying over the entire life of the loan, with all things included. Question number 5. The term amortization refers to A, interest-only payments over the life of a loan. B, a balloon payment at the end of a loan. C, payment of a debt in regular periodic installments of principal and interest. D, a repayment of a loan by principal payment only. The correct answer here is C, payment of a debt in regular periodic installments of principal and interest. So if you understand what the term amortization means, you would understand that this is the process of paying off debt with periodic payments that cover both principal and interest. The most common loan that we see, the 30-year fixed mortgage here in the United States, is typically an amortized loan. So every month, these monthly payments are paying off principal and interest every month. So we're halfway through the questions. I get emailed a lot, and a lot of people comment and they ask for where do I get the test questions? What's the best place to get a good test bank of questions that will help me pass the exam? So I have a link to Calibri. This is the same platform that I personally used to pass my real estate exam and loan officer license exam. Currently using their materials to get my broker's license as well. I'm dropping a link, full disclosure, it's an affiliate link. So if you buy something on there, you are helping support me as well. I get a little piece of that, but I wouldn't be sharing it if I didn't actually believe in the product and use it myself. So check it out. There's a link in the description. Let's get back to the questions. Question number 6. Which act prohibits discrimination in lending practices? A, the UNRRA Civil Rights Act. B, the Rumford Act. C, the Class Act. That's me. D, the Holden Act. So the correct answer here is D, the Holden Act. The Holden Act prohibits redlining and other discriminatory practices in lending. So when you are studying the financing questions, there will be a good amount of questions asking about regulations and how those regulations protected the consumers. So when you're studying and you're reading the chapter summaries, learning about these different acts, if you can just connect, hey, the Holden Act prevents discrimination, then you will do very well. Make sure you spend some time studying those different acts, different laws, and make sure you understand what change those laws created. Question number 7. Which loan is not guaranteed or insured by a government agency? A. FHA. B. VA. C. Conventional. D. Land contract. So the correct answer here is C. Conventional. Conventional loans are neither guaranteed nor insured by the government. An FHA loan and a VA loan are both guaranteed by government. Conventional loans are not. And once you start working in real estate, you actually see typically FHA loans and VA loans, they have lower interest rates. Conventional loans are typically a little bit riskier because they're not government insured, so they have a higher interest rate. That's not always the case, but that's a general rule. Question number 8. What is the foreclosure time frame under a trustee sale? A. Minimum of 2 months and 21 days. B. Minimum of 3 months and 21 days. C. Minimum of 4 months. D. Minimum of 1 month. Correct answer here, minimum of 3 months and 21 days. So trustees must wait 3 months before recording a notice of sale and advertise for 20 days, which totals 3 months and 21 days. We don't want anyone to get foreclosed on, but hopefully they can make it right in that time frame. All right, question number 9. What is the temporary loan made on a borrower's equity in their present home? A. Package loan. B. Swing loan. C. Blanket loan. D. Balloon payment loan. So the answer here is B, a swing loan. This is actually more commonly known as a bridge loan. A common scenario for this bridge loan is when someone is buying a new home, they have equity in their old home, and they use the equity in their current home to actually buy the new home before they sell their current home. So that's the most common scenario of the swing or bridge loan. So I hope you've enjoyed studying with me so far. We're here. Question number 10, the last question related to financing for today. If you've enjoyed studying the questions with me, go ahead and smash that subscribe button. There's going to be videos like this every week. And I do want to see you pass your real estate exam. I want to see you crush it. Okay, let's get to this final question. The term debt service refers to A, an instrument used in many states in place of a mortgage. B, the amount of money owing on a note or promise to pay. C, the amount of money paid in regular intervals to reduce the balance owed on a debt. D, the movement of money out of a savings account into a higher yield investment. Correct answer here is C, the amount of money paid in regular intervals to reduce the balance owed on a debt. So if you just understand the term debt service, all debt service are the periodic payments made to cover the interest and principal on a loan. So it's a simple definition one. When you are studying, I highly recommend you go through the definitions and the important terms and you just know what those mean, because you'll get questions just like this. And if you know what these words mean, those are free, easy points. Now that we've gone through about half of the video, I want to invite you to the next steps of after passing the exam. I send a weekly email dedicated to new agents just like yourself's success. And you can sign up for these emails using the link below. Let's get back into these test questions so you can pass your exam. Question number 1. An alienation clause in a mortgage refers to the clause that A, says the entire mortgage is due if the owner moves outside the US. B, allows the lender to charge a penalty for early payment. C, allows the lender to call for full payment of the mortgage because the owner transferred ownership to another party. D, pledges the property as security to a third party. Correct answer here is C, allows the lender to call for full payment of the mortgage because the owner transferred ownership to another party. The alienation clause basically ensures the lender's control when ownership is transferred. This is also known as a due on sale clause. Question number 2. What type of note calls for interest payments during the term of the loan and principal due at the end of the loan? A. Straight term loan. B. Installment loan. C. Amortized loan. D. Balloon wraparound loan. Correct answer is A. Straight term loan. So a straight term loan involves paying only the interest during the loan term and then a lump sum principal payment due at the very end. Question number 3. An investor decides to take money out of a savings account and invest it in corporate securities to obtain a higher yield. This movement is known as A. Disintermediation. B. Dedication. C. Debt service. D. Discrimination. The correct answer here is A. Disintermediation. So this pretty much just means you're moving money out of low yield accounts like savings and moving it into higher investments. It's definitely not discrimination. Banks and investment firms are not going to discriminate when you put your money into their accounts. Question number 4. What is the temporary loan made on a borrower's equity in their present home? A. Package loan. B. Balloon payment loan. C. Blanket loan. D. Swing loan. The correct answer here is D. Swing loan. So, swing loans are more commonly known as bridge loans, and these allow borrowers to use the equity in their current home to go ahead and buy a new one before selling that old one. Question number 5. Notice of default must be executed before notice of sale is given. How long before notice of sale must this occur? A. 6 months. B. 10 days. C. 3 months. D. 2 months. The answer is C. 3 months. So notice of default must be recorded and given at least 3 months before issuing a notice of sale. Question number 6. The note that calls for periodic payments on the principal and a balloon payment at the end is called A. A straight note. B. Adjustable rate note. C. Fully amortized installment note. D. Partially amortized installment note. Correct answer here is D. Partially amortized installment note. So if you remember, a straight note, that's just interest. Adjustable rate note, that means the rate is adjustable. See, a fully amortized installment note means that every monthly payment you're paying off principal and interest. So at the end, there's not going to be like a lump sum payment towards principal, and that just leaves us with answer D. Right? You're going to periodically make principal payments, and then the remaining balance of the principal will be due at the very end. Question number 7. RESPA regulations would not apply to which of the following? A. First lien residential mortgages. B. The second or subordinate lien for home equity loans. C. A transaction financed solely by a purchase money mortgage taken by a seller. D. 1 family to 4 family loans. Correct answer here is C. A transaction financed solely by a purchase money mortgage taken by a seller. So what this means is that the seller actually financed the purchase. So this would be considered a private arrangement between the seller and the buyer, and RESPA does not cover those types of things. And to go back to this one, right? So if you didn't know, a seller can actually sell their home and they can become the bank. They can do what's called seller financing. If they don't own, if there's no debt on the property or the debt is paid off through a down payment, sellers do have the right to become the bank when they sell their home. Question number 8. The term debt service refers to A. An instrument used in place of a mortgage. B. The amount of money paid in regular intervals to reduce the balance owed on a debt. C. The movement of money out of a savings account into higher yield investment. D. The amount of money owing on a note or promise to pay. Correct answer here is B. The amount of money paid in regular intervals to reduce the balance owed on a debt. That's all the debt service is. Question number 9. In return for beneficial loan terms, a borrower may obtain a type of loan where the lender shares the property's appreciated value. This loan is called A. Graduated payment adjustable mortgage. B. Shared appreciation mortgage. C. Variable or adjustable rate mortgage. D. Rollover mortgage. Correct answer here is shared appreciation mortgage. So shared appreciation mortgages allow lenders to share in the future appreciation of the property. A good example of this one is if you're in California, you might have heard of the California Dream for All. And so that program actually was a shared appreciation mortgage. These shared appreciation programs are often seen in down payment assistance programs. So some real estate professionals they actually advise their clients to stay away from these types of programs, but some of them are a great way for people without a down payment to get into a home. Question number 10. When a trust deed debtor is in default, the loan may be reinstated if all delinquencies and fees are paid prior to how many days before a trustee sale? A, 10 days, B, 3 days, C, 5 days, D, 7 days. Correct answer is C, 5 days. So borrowers have until 5 days before the trustee sale to reinstate the loan by paying all amounts due. Okay, so we're halfway through 20 questions. We just finished question number 10. I make these videos to help people get their real estate license, and I want to see people do well in their real estate career. So I have created a weekly newsletter that shares the mistakes that I've made, tips for real estate agents to generate more business, and just share some of my experiences as a real estate agent. If you'd like to get that weekly email, go ahead. There's a link in the description here, and you can just sign up to get those weekly emails. All right, back to the questions. Question number 11. A provision of a promissory note or mortgage where, upon the happening of a certain event, for example, default, the entire unpaid balance becomes due immediately is known as A, inchoate clause, B, habendum clause, C, indemnification clause, D, acceleration clause. The answer here is D, acceleration clause. So this basically just allows the lender to require immediate repayment of the entire loan balance if specific conditions are met. Question number 12. RESPA requirements would not apply in which of the following situations? A, when the property mortgage is insured by FHA. B, to a conventional loan that would not be sold on secondary mortgage markets. C, when property is purchased with a federally related mortgage loan. D, when the property mortgage is guaranteed by VA. Correct answer here is B, to a conventional loan that would not be sold on the secondary mortgage markets. Question number 13. A type of financing for real estate mortgages where the annual percentage rate varies year to year based on lender specific terms is known as A, adjustable rate mortgage, B, amortized loan, C, fluctuating loan, D, fixed rate mortgage. Correct answer here is A, adjustable rate mortgage. Just in the name of an adjustable rate mortgage, you know that something's changing, right? Because it's adjustable. And so these adjustable rate mortgages, also known as ARMs, they have an interest rate that adjusts periodically based on the terms of that loan and the market conditions. Question number 14. The note that calls for the payment of interest only is called A, straight note, B, fully amortized installment note, C, partially amortized installment note, D, adjustable note. Correct answer here is A, straight note. So we kind of went over the other definitions in the past. Adjustable means that it's going to change. Fully amortized installment note means that you're paying principal and interest every month. Partially amortized means you're paying some principal and some interest every month. So when you're studying, make sure you know what these different loan types are, the definitions of these words, and these questions are going to be a slam dunk. They're going to be easy for you. Question number 15. The note in which the interest rate varies upward or downward over the term of the loan is called A, adjustable rate note, B, fully amortized installment note, C, straight note, D, partially amortized installment note. Correct answer here is A, adjustable rate note. Question number 16. The law that requires a lender to disclose the cost of getting a loan is A, truth in lending, B, RESPA, C, FHA, D, caveat emptor. Correct answer here is A, truth in lending. So the Truth in Lending Act mandates that lenders disclose all loan costs, including interest rate and finance charges. So when you are studying, make sure that you know what the Truth in Lending Act is. Make sure you know what RESPA is. Make sure you understand how these different laws and regulations impact the consumers and how consumers are being protected by these laws. Question number 17. A partially amortized note that reduces part of the principal by the time the final payment is due is often called A, conventional loan, B, a wraparound mortgage, C, balloon payment slash balloon note, D, fully amortized loan. Correct answer here is C, balloon payment and balloon note. Once again, you just need to understand what types of loans are out there, the features of those loans, definitions of these words, and you will crush your exam. The buyer agrees to purchase real property by making monthly payments to the seller and then receiving a deed at a later point in time. This agreement is known as A, land installment contract, B, construction loan, C, certificate of sale, D, straight term mortgage. Correct answer here is A, land installment contract. So, land installment contracts involve regular payments to the seller with the deed transferred after the full purchase price is paid. Question number 19. Net income can be defined as A, income after expenses, B, effective gross income, C, potential gross income, and D, total of all income. Correct answer here is A, income after expenses. So if you just understand the basic net income calculation, this question's easy for you. Question number 20. A lender wishes to make the yield on a lower than market interest rate loan competitive with higher interest rate loans. What would the lender charge to make the loan competitive? A, penalty points. B, discount points. C, debt service. D, deed in lieu of foreclosure. Correct answer here is discount points. Discount points are charged up front to increase the lender's effective yield on a loan with below market interest rates. I hope you've really enjoyed studying with me and that you passed your exam on the first try. And if you want to study some more, I have a playlist full of more test questions that you're going to see on the exam. Best of luck studying, and I'll see you on the next video.